Hello, Kimball. It seems like bond markets have finally begun to take the U.S. fiscal trajectory in a serious way. My question for you is, what would be the impact of a secularly higher yield regime on the economy and on markets?
I think markets are, beginning to sort of suss that out. I don't think, though, that they're overreacting. And interest rates are quite reasonable right now. I mean, they're consistent with long-term averages. Credit spreads are consistent with long-term averages. And so it's hard to argue that there is an overwhelming, sort of feeling that the fiscal situation in the U.S. is like top of mind. We'll say with the private sector, with the corporate sector, most companies have used the very low interest rate regime that existed for many years to refinance and kind of immunize themselves from higher rates. And it's really a government phenomenon that we've got to deal with. How that evolves, we'll see. But I don't think that the market is indicating that it's a major problem.
I'd like to shift gears and ask you about the outperformance of international markets over the U.S. So year to date, U.S. markets are lagging by about mid-teens, and half of that's currency related. Can you talk about why this could persist going forward?
I think that it can, and I think that the reason for it is the valuation backdrop that started this sort of outperformance of international markets. And you've got a situation where, fundamentally, cash flows outside of the U.S. are, I think, mispriced. I mean, they're underpriced. And that's sort of part of the story that's going on here. And I think that it can continue. I do feel that that there are many companies outside of the U.S. that are, well governed and careful about kind of how they deploy their excess cash flow, and I think it should benefit them over the long term in terms of overall valuations. That's kind of the story, I think, for investing in international markets.
Well, thank you very much for your time today, Kimball.